Hey, Eric here, and today I want to share 3 tips for beginners who wants to start in investing. Now, investing is not exactly a fair game, and it is very important for you to know what you're doing before you put money on the line. So, first thing is that you want to decide what kind of investor you want to become. Now, a lot of people are lured to day trading or swing trading, basically short-term investing that takes up a lot of time. Now, this is especially true for young people between their 15 to 30, where you have a lot of time on your hand and you think you can spend a lot of time watching the market to extract a higher return. But on the other side is if you spend so much time on investing, you got to include the cost of your time. You could have been doing a job, you could be learning another skill instead of investing. And you got to consider about how big your portfolio is. For example, let's say in the general market you make around 10%. That's pretty standard for the stock market. And by watching the market every day, you're able to make 30%, which is pretty good. And Warren Buffett only makes 30%. So if your portfolio is only $10,000 and you make 30% a year, that's only $3,000. So you got to think about if it is really worth it to put in that much time into managing your own portfolio. So in my opinion, I've been through the stage of day trading, swing trading, medium to short-term trading, and now I finally chose my style and I'm a long-term investor. Usually I look 2 years to 5 years in advance. When I buy a company, it's similar to Warren Buffett, where I want to hold it for as long as possible because I know time is in my favor. So that's the first thing, choosing who you want to be. Second, the approach. Now, a lot of people start investing without a proper approach. Now, what do I mean by an approach? Do you know what you're doing before investing, during, basically after you place a trade or an investment, and after you invest? Now, if you don't know what you're doing and you basically run on recommendations, what will happen is your friend will tell you, hey, Eric, I think this is a good buy. You should check it out. And you go like, oh, wow, it's really going up and I think it's a good buy. I really like the company. And without doing further research, you just click buy. And chances are, when your friend is telling you, it's already at a high, because your friend is probably making money from that stock, and if he's making money, then the price is high and he's probably looking to exit it for a profit, and now you are looking to buy into a stock that is at a high price, hoping it will go up just a little bit more. And that's usually a recipe for disaster. So once you have your approach laid down, the last thing you need to do is to make sure you have tested the approach. Now, a lot of approaches sound good on paper, and I understand that. Like if you search investing approach on Google, you're going to find thousands and thousands of strategies, ranges from looking at a PE ratio or technical analysis, or different kind of combination of indicators put together, and different money management strategy. You get the idea. But if you're looking at the volume of approaches, a lot of them are not tested. And a lot of them are not universal. For example, a certain approach might work in one market and completely fail in the next one. And it's very important to you to understand what kind of approach works for you and what kind of approach you want to take. And that requires testing. Now, a lot of people will recommend you to get a stock simulation account, such as those live, like you get $1 million to trade in your stock account, and then you can trade live with the market, except it's not real money. Now, that sounds really good in theory, but the problem is it doesn't allow you to test rapidly. This is why you need a simulator that allows you to fast forward. It allows you to go through years and years of data in a matter of minutes. So when I practice investing, I use something called the Forex tester. Now, Forex is the foreign exchange market. And for beginners who don't know much about Forex, Forex is a almost pure technical analysis market. Basically 80% or more traders use technical analysis because you don't have a lot of fundamental analysis data. It's not like you're investing in a company where you have like the quarterly financials, you have news surrounding the company, you know who the executives are. For Forex, it's a lot based on the government and mostly is technical. So I use that to train up my technical skills. So once you test your strategy, then and decide what kind of investor you want to be, then you will be ready to go. Now, having said that, I usually recommend people to start investing at around $10,000 because this allows you to place a few trades. Like if you have around $3,000, which is what I started with, I can only place 1 to 2 trades. That's it. So you got to think long and hard about how much money you're starting with, because if you are only starting with $3,000 and you can only buy one thing in the market, then you might want to think, okay, I'm putting a lot of stress on myself because my first investment, when I have the least amount of experience, is what I need to get right. So yeah, let me know if you have any other tips for beginning investors, or if you have any questions if you are just starting out in investing. Leave a comment below and I'll try to reply as soon as possible.